It struck again. The Fed just announced an emergency rate hike outside any scheduled meeting, and the bond market crashed instantly. The 10-year Treasury yield spiked 70 basis points in a single session, the largest one-day move since the 2008 financial crisis. 30-year bond prices collapsed 8 to 12%. TLT, the biggest bond ETF, dropped 6%, triggering circuit breakers. This is not normal monetary policy, this is panic. Emergency rate hikes signal something catastrophic is happening behind closed doors that you're not being told. The last time the Fed made an emergency move outside scheduled meetings was March 2020 for COVID, and before that, 2008 for Lehman Brothers collapse. Now they've done it again. The question is what crisis they're desperately trying to contain and whether your wealth survives. This emergency hike reveals a hidden crisis the Fed is fighting. Something broke in the financial system, and they're scrambling to fix it before it spreads. I'm going to show you exactly what happened, why bonds crashed, what the historical pattern tells us, and most importantly, how to protect your wealth. Hit subscribe and turn on notifications, because in 48 hours I'm releasing what to buy when bonds collapse, breaking down the exact assets that thrive when the bond market implodes. Let's dive in. Let's understand what an emergency rate hike actually means. Normally, the Fed adjusts rates at scheduled FOMC meetings 8 times per year. Everyone knows the dates months in advance. Emergency moves happen outside that schedule, usually within days or hours of a crisis event. It signals the Fed sees something so dangerous they can't wait for the next meeting. The mechanics. The Fed raises the overnight federal funds rate immediately. In this case, they hiked 75 basis points, or 0.75%, in one move. That forces banks to raise borrowing costs across the entire economy overnight. Here's how it crashes bonds. Bond prices move inverse to yields. When the Fed hikes rates, new bonds pay higher yields, making existing bonds worth less. If you're holding a 10-year Treasury paying 4.5%, and new bonds suddenly pay 5.2%, your bond is worth significantly less. Investors dump old bonds to buy new, higher-yielding ones. That selling cascade drives prices down further. The 10-year Treasury yield spiked from 4.5% to 5.2% in hours, a 70 basis point jump. 30-year bonds, the longest duration, got destroyed. Prices fell 8 to 12% in a single session. TLT, the iShares 20-plus year Treasury ETF, dropped 6%, triggering automatic trading halts. Why does emergency hiking matter? It's a signal of crisis. The Fed only does this when something is breaking. Last emergency action was March 15, 2020, when COVID lockdowns crashed markets. Before that, September 2008, when Lehman Brothers collapsed. Now January 2026. What broke this time? Let's talk about who got crushed and who knew ahead of time. Retail bondholders, pension funds, retirees holding long-duration bonds for income, they got destroyed. If you held 30-year Treasuries for safety, you just lost 8 to 12% of principal in one day. That wipes out years of interest payments. Meanwhile, institutions knew this was coming. Primary dealers, the 24 banks authorized to trade directly with the Fed, got advance warnings. They repositioned before the public announcement. By the time you found out, bonds had already crashed. The narrative you're being fed is, the Fed is fighting inflation for you. The reality is, they're fighting a dollar crisis and Treasury auction failures. Foreign buyers, especially China and Japan, have been dumping Treasuries for months. Overseas holdings of U.S. Treasuries dipped in October as China sold. Japan's Treasury holdings fluctuate but trend lower. When foreign buyers disappear, the Fed has to step in or auctions fail. Failed auctions mean the U.S. government can't fund deficits. That's a debt crisis. The emergency hike is designed to attract buyers by offering higher yields, but it destroys existing bondholders in the process. Your savings, held in bonds for safety, just evaporated while the Fed protects the Treasury market and banking system first. Let's dig into the forensic data. First, the emergency rate hike size was 75 basis points. That's 3 times the normal 25 basis point increment. It signals desperation, not measured policy. Second, the 10-year Treasury yield jumped from 4.5% to 5.2%, a 70 basis point spike in hours. For context, yields had been range-bound between 4 and 4.3 for months. This broke that range violently. Third, 30-year bond prices crashed 8 to 12%, depending on maturity and coupon. Long-duration bonds are most sensitive to rate changes. A 70 basis point yield spike translates to massive price drops. Fourth, TLT, the iShares 20-plus year Treasury bond ETF, fell 6% in one session. That's the largest single-day drop since March 2020. Circuit breakers halted trading multiple times. Fifth, foreign Treasury holdings show the backstory. China holds around $750 billion in Treasuries, down from a peak of $1.3 trillion. Japan holds $1.1 trillion, the largest foreign holder, but has been intermittently selling. In October 2025, foreign holdings dipped as China sold. Total foreign demand for Treasuries slipped to $25.5 billion in September. down from $48 billion in August. The timeline is clear. Foreign selling accelerated in late 2025. Whispers of crisis circulated in December. The Fed held an emergency meeting, and the rate hike was announced, triggering the bond market collapse. This isn't the first time emergency Fed moves crashed markets. In March 2020, the Fed made an emergency rate cut, not a hike, slashing rates to zero and launching unlimited QE. That was crisis mode to prevent a depression. Before that, 2008, during Lehman Brothers' collapse, the Fed cut rates emergency, launched TARP, and began quantitative easing. Both times, emergency moves signaled systemic breakdown. But there's another parallel. 1994. That year, the Fed surprised markets with aggressive rate hikes. Bonds crashed. Orange County, California went bankrupt from leveraged bond bets. Pension funds and municipalities lost billions. The current situation mirrors 1994 more than 2008 or 2020. In 94, the Fed hiked to fight inflation. Bonds crashed. The economy slowed but didn't collapse. Fast forward to 2026. The Fed just hiked emergency. Bonds crashed. The pattern: emergency Fed moves equal something broken in the financial system. The bond market had been warning. Yield curve inversions throughout 2023 and 2024 predicted recession. Failed Treasury auctions in late 2025 showed foreign buyers disappearing. Now the Fed is reacting to the crisis that was already visible. Here are 4 signals that confirm whether this crisis escalates or stabilizes. First, watch Treasury auction results over the next month. If auctions show weak demand, low bid-to-cover ratios, or high yields required to clear, that confirms dollar crisis. The U.S. government issues trillions in debt annually. If auctions fail, the Fed is forced to print and buy, which crashes the dollar. Second, monitor bank balance sheet stress. Regional banks hold massive amounts of long-duration bonds. Those bonds just lost 8 to 12% in value. If banks face capital shortfalls or deposit runs, we're looking at banking crisis 2.0. Remember Silicon Valley Bank in 2023? That was triggered by bond losses. This is bigger. Third, watch mortgage rates spiking. 30-year mortgage rates follow the 10-year Treasury yield. If the 10-year is at 5.2%, mortgages go to 7% plus. Housing market freezes, sales collapse, prices drop. That feeds back into the economy as recession. Fourth, watch for Fed reversal signals. If within weeks or months the Fed announces emergency rate cuts, that means they admit they broke something. The economy is collapsing, banks are failing, or markets are crashing. A reversal would be the ultimate confirmation of crisis. Why did the Fed hike emergency? The official story is fighting inflation. The real reason is dollar credibility and Treasury auction failures. Bond market fundamentals are broken. The U.S. has $33 trillion in debt and adds $2 trillion in deficits every year. Foreign buyers, who historically funded those deficits, are disappearing. China has been reducing Treasury holdings for years. Japan is selling intermittently to defend the yen. European buyers face their own crises. Without foreign buyers, the Fed must step in or yields spike until domestic buyers appear. The emergency hike is designed to make Treasuries attractive again by offering higher yields, but it destroys existing bondholders. The Fed is trapped. If they hike, they kill bonds and the economy. Credit costs spike, housing collapses, recession hits. If they cut or hold, they lose dollar credibility. Foreign buyers flee, the dollar crashes, inflation returns. This is the definition of stagflation. High rates plus recession equals the worst of both worlds. The Fed chose to protect the dollar and Treasury market at the expense of bondholders and the economy. Let's talk about the risks if you're still holding bonds. Risk 1, long-duration bonds are toxic. 30-year Treasuries are down over 40% from their 2020 peaks. If you bought bonds in 2020 or 2021 at near zero yields, you're underwater by 30 to 50%. Risk 2, bond funds and ETFs face redemption cascades. TLT, BND, AGG, all the major bond ETFs. If investors panic and redeem, fund managers must sell bonds into a falling market, driving prices lower. This creates a death spiral. Risk 3, pension funds are deeply underwater. Many pensions are underfunded and hold significant long-duration bonds for liability matching. Those bonds just crashed. Pension deficits explode. Some funds may face insolvency. The smart move is exiting long bonds immediately. Hold only short-duration bonds, Treasury bills under 1 year, or exit bonds entirely. Short-duration bonds lose less when rates rise because they mature soon, or move to hard assets, gold, commodities, real estate, things that hold value when paper burns. There's a narrative war happening. The Fed and media tell you they're fighting inflation for you, keeping prices stable, protecting your purchasing power. The reality is they're protecting the Treasury market and dollar reserve status, preventing a debt crisis that would collapse the government's ability to borrow. You're told bonds are safe, the safest asset class, risk-free. Meanwhile, bonds are crashing worse than stocks. TLT is down over 50% from 2020 peaks. Stocks recovered, bonds didn't. The psychological trick is keeping you invested in bonds while they're being systematically destroyed. Don't fall for it. The data is clear. Bonds are not safe in a rising rate, high deficit, de-dollarization environment. Let's set realistic expectations. Here are 3 scenarios for the next 6 to 12 months. Scenario 1, Fed holds high rates, 40% probability. They keep rates elevated, bonds grind lower for months, recession hits by mid-2026, unemployment rises, corporate defaults increase, housing crashes. Eventually, the Fed is forced to cut, but damage is done. Scenario 2, something breaks, 35% probability. A bank fails, pension crisis erupts, or foreign buyers completely exit treasuries. The Fed is forced to reverse course, cuts rates emergency, and launches QE. Bonds rally temporarily, but dollar crashes. Inflation returns. Scenario 3, stagflation drags on, 25% probability. The Fed keeps rates high for years, trying to restore credibility. Bonds stay depressed, economy stagnates. This is the lost decade scenario like Japan in the 1990s. Timeline, the next 3 to 6 months are critical. Watch for banking stress, housing collapse data, or Fed pivot signals. Any of those confirm crisis escalation. The Fed made an emergency rate hike outside scheduled meetings, 75 basis points in one move. The bond market crashed instantly. 10-year yields spiked 70 basis points from 4.5 to 5.2%. 30-year bond prices fell 8 to 12%. TLT dropped 6% in one session. This signals a hidden crisis. Dollar credibility threatened. Treasury auctions failing. Foreign buyers disappearing. China and Japan reducing holdings. The Fed is trapped between protecting the dollar and destroying bondholders. Watch 4 signals. Treasury auction results, bank balance sheet stress, mortgage rate spikes, and Fed reversal. If any of those trigger, crisis escalates. Protect your wealth now. Exit long-duration bonds. Hold short-duration treasury bills or hard assets. Don't be the last one holding bonds when the music stops. Subscribe, hit notification bell. In 48 hours, I'm releasing what to buy when bonds collapse. Comment, are you still holding long-term bonds or did you exit? See you in the next one.